Well, hi, and welcome back to Reflections in Real Talk. I'm Judy, a working professional navigating retirement planning after sharing my passion with friends and family. I often hear the same thing. Investing is just too complicated and I don't know how to do it myself. That might have been true before the internet, but now we have access to easy-to-use platforms that make investing simple, affordable, and empowering. In this video, we're going to break it down and talk about one of the most user-friendly, low-stress ways to build wealth over time. Using 2, 3, and 4 fund portfolios, whether you're starting late, playing catch-up, or just want to simplify your financial life. This video is for you. Why do simple portfolios work? Because whether you're starting with $100 or you have $1 million nest egg, investing should be simple. If it's complicated, chances are you're overthinking it or someone's trying to sell you something. Some financial managers try to bamboozle you with complex strategies just to make you think you can't do it yourself. But I'm here to tell you, you absolutely can. You don't need 15 or 20 funds to be diversified. Now, I'm not a financial planner, and I'll mention a few well-known funds for reference, but always do your own research. And believe me, I've been there. You start researching how to invest, and 30 minutes later, you've got 19 tabs open on stocks, crypto options, ETFs, and it can be overwhelming. But here's the simple truth. Simple wins. Jack Bogle, the founder of Vanguard, built an entire movement around this. The research backs it up. Portfolios with just a few well-chosen index funds often outperform complex, high-fee strategies over the long haul. And best of all, they're easy to maintain. No stock picking, no guessing, and far fewer chances to panic and sell when the market dips. Let's start with the most basic strategy, the one fund portfolio. That's a target date retirement fund. I go into detail on that in a 2-part series, and I'll put a link in the description below. But today, we're going to focus on 2, 3, and 4 fund portfolios. These are perfect if you're managing your own money, want more control, or just want to keep things simple. Let's start with a 2 fund portfolio. Fund 1, a total U.S. stock market index. This gives you instant diversification with exposure to big names like Apple and Amazon, and also smaller companies across all sectors. Well, here I'm sharing my screen so you can take a closer look at VTSAX. That's the Vanguard Total Stock Market Index Fund Admiral shares. This is one example of a total stock market index fund, and it's offered by Vanguard, which is known for its low-cost investing options. Right away, you can see a few things. The expense ratio is just 0.04%, which means you're paying only 40 cents per year for every $1,000 you invest. That's extremely low compared to actively managed funds, which often charge 1% or more. Now, looking at the performance chart, you can see how the fund has performed over time compared to its benchmark. And if we scroll down a bit, we can dive into fund composition. VTSAX holds 3,564 individual stocks, which means with just this one fund, you're instantly diversified across the entire U.S. stock market, from large cap to small cap companies across all sectors. That's a huge benefit of index funds, broad diversification with minimal effort. Over here in the style box, you'll see that VTSAX falls into the large blend category, meaning it includes both growth and value stocks from large U.S. companies. But remember, it's not just large cap. This fund also includes mid and small cap stocks, so it's really giving you total market exposure. Further down, we can explore the sector breakdown. You'll see a mix of industries represented: basic materials, consumer discretionary, healthcare, financials, energy, and so on. But it's heavily weighted in technology, which makes sense because tech companies like Apple and Microsoft have such large market capitalizations. Speaking of which, look at the top holdings: Apple, Microsoft, Nvidia, Amazon, Facebook, Berkshire Hathaway, Alphabet, Broadcom, Tesla, Eli Lilly. You've probably heard of those referred to as the Magnificent Seven, and they play a big role in the performance of U.S. markets today. If you want to scroll down even further, you can see a detailed listing of holdings, and it includes many companies like Walmart, Procter & Gamble, MasterCard, ExxonMobil, Netflix, and many others. And this really gives you a sense of how widely spread your investment is if you're not betting on just one company or even one industry. One thing I do want to point out, there is a minimum investment here of $3,000, and you might consider some other alternatives like VTI. the ETF version for those starting with less. Fund 2, a total U.S. bond market index. This adds stability and income, especially as you approach retirement. Vanguard's VTSAX and VBTLX are classic examples, but Schwab and Fidelity have great low-cost options too. You might go into 80% stocks and 20% bonds in your 40s or 50s and shift towards a 60-40 or even 50-50 portfolio as you get older. The beauty is flexibility, low cost, and easy to automate. Now let's move to the 3-fund portfolio. This is what I personally use. It's incredibly popular among long-term investors. Fund 1 is the total U.S. stock market. Fund 2 is total international stock market. And Fund 3 is a total U.S. bond market. Why add international? Because growth doesn't only happen in the United States. There are thriving markets in Europe, Asia, and emerging economies. This portfolio gives you global exposure plus income and protection through bonds. It's great if you're in your 40s, 50s, and 60s and want a balanced approach with long-term growth. And it's easy to rebalance once or twice a year. That's it. Next up is the 4-fund portfolio. This one takes the 3-fund foundation and adds a real estate investment trust or REIT. REITs invest in real estate like apartment buildings, malls, and commercial properties. They pay dividends and add diversification, a great way to get real estate exposure without becoming a landlord. I recommend keeping REITs to about 5 to 10% of your portfolio. There's also a variation of the 4-fund portfolio that uses dividend-paying stocks instead of REITs. I cover dividend stocks in a 2-series video set. I'll put those links in the description below. Now let's talk about the psychology of keeping it simple. The more complicated your investments are, the more likely you are to tinker with them, and that can hurt you. I've seen it with friends and even myself. When the market takes a dip, a messy portfolio makes you feel like you've got to do something. But with a 2, 3, or 4-fund strategy, you're more likely to stay on course, ride out the storm, and come out ahead. That's where real wealth is built, not from chasing trends or trying to beat the market, but staying invested in a smart, simple strategy. I also want to touch on what happened in 2008. When the financial crisis hit, the market dropped nearly 50%. A lot of people panicked, myself included. I get it. Retirement accounts were cut in half, homes lost value, and it felt like the economy was falling apart. But those who stayed invested, who stuck to their plan, and saw their portfolios rebound and grow. The S&P 500 has more than quadrupled since those lows. That's why simplicity and consistency matter. And finally, remember that many financial advisors who sell products like annuities are compensated through commissions. Some receive 5 to 7% upfront on the money they invest, which means a $100,000 annuity can generate $5,000 to $7,000 for the advisor, whether it's the right product for you or not. That's why I'm such a fan of low-cost DIY strategies like these portfolios. You keep more of your money working for you. Now, if you're just getting started and you want some resources to help you along the way, here are a few that I can recommend. Check out bogleheads.org. It's a fantastic forum for learning how to build simple, low-cost index fund portfolios. Their wiki has sample 3-fund portfolios and explains them in plain English. Another great site is mymoney.gov. This is a government-run site with a free educational tool about budgeting, investing, and retirement planning. If you want hands-on help building a portfolio, check out the calculators at Vanguard, Fidelity, or Schwab. They'll walk you through sample allocations based on your age and risk level. And if you like video learning, check out the original Jack Bogle interviews available right here on YouTube. So let's recap. Whether you're choosing a 2, 3, or 4-fund portfolio, you're choosing a low-cost, low-stress way to invest for your future. These portfolios are simple, effective, and easy to manage. Pick one that fits your style, automate your contributions, and then just let it grow. If you found this helpful, give it a thumbs up and hit that subscription button. I share financial strategies for anyone planning for a better retirement. This is Judy, and I'll see you next time on Reflections and Real Talk. Keep it simple and keep moving forward.